Hello and welcome to the second leg of my tour of Canada's mortgage ecosystem. And I said at the start of the journey that there are three species of mortgage lender in Canada. We've got traditional, alternative, and private. And today I'm going to talk about the alternative mortgage lender, which is the most rapidly growing segment of the Canadian mortgage landscape. Why? Basically because the traditional lenders that I talked about last episode are so tough to qualify for in terms of their own internal lending policies and federal legislation placed upon them when it comes to down payment and income verification that a growing amount of Canadians are getting kicked out of the traditional space, much to their surprise. So it's the job of the mortgage broker, the mortgage advisor, to inform the Canadian consumer of this rapidly growing group of lenders that are rushing to accommodate these Canadians. And you'd be surprised to know that these alternative mortgage lenders are actually divisions or subsidiaries of major Canadian banks and trust companies and monoline lenders and credit unions. And just to name a few, you've got Canadian Western Bank has a division named Optimum Mortgage. You've got Laurentian Bank's got an alternative division that's known as B2B Bank. You've got the monoline lenders like CMLS has their Aveo product line. MCAP and RMG share the Eclipse line of alternative mortgage products. Who else am I thinking? You've got Street Capital has Street Capital Solutions. Merix and Lenwise have a suite of alternative products called NPX. And then you get into the credit unions who offer traditional and alternative mortgage products all under the same roof, which is why there's sort of a blur between traditional and alternative. And that's sort of a coverage of who's who in that part of the zoo of alternative mortgage lenders. And what is an alternative mortgage at the end of the day? When your mortgage broker advises you that you qualify for an alternative mortgage, what exactly is it? Well, it's a mortgage, in short, that's going to be sympathetic to a lot of the constraints of the traditional lender. They're going to be a lot more flexible on the major items for qualification than a traditional lender, all at a cost of slightly higher rates and fees. So right off the bat, down payment for a purchase with an alternative mortgage is going to be at least 20%. So there's no provision in the alternative space, at least yet, for a person to purchase a home with less than 20% down or go as little as 5% down and make use of the Canada's mortgage insurers like CMHC. It's got to be 20%, and it could be as high as a 35% down payment or 35% equity in the case of a refinancing. Rates are going to be higher in exchange for the flexibility that I'm about to describe. So let's just say June 2018, fixed rate mortgages at a traditional lender are going to be 3% odd. Alternative lenders are going to be 4, 5%, and they're going to have a fee, usually around 1% of the actual mortgage being offered as an upfront fee that's split between the lender and the broker for originating the mortgage. These alternative mortgages are known as stepping stone lenders. So they're usually offering their products to you on an interim basis. So the terms for these mortgages are typically 1, 2, and 3 years. And they have 30-year amortizations behind them, commonly. In fact, there's some cases where there can be a 35-year amortization, just from a cash flow perspective to spread those higher rate mortgage payments just a little bit thinner. We then get into why they are so more aggressively priced than traditional lenders, because they're just so much more flexible. They are a lot more sympathetic for people with reduced credit scores and credit histories. For example, people that may have been bankrupt recently due to the failure of a business. There may have been a turn in your health. You may have suffered a failure in your business, or you may have come across some sort of financial hardship, or even a breakdown in your marriage, as we sometimes observe. Credit will suffer sometimes in the wake of a disintegrating marriage. So there's credit. And then when it comes to income, this is where the interesting part comes in. Traditional lenders, as I alluded to in my LinkedIn article, I'll put a link to that below, they are looking very precisely at your income in terms of whether it's verifiable and reliable and tax paid, and they'll rely on tax documents only, and they'll just take it to the penny of the amount of income that you have reported to a third-party source. Whereas a traditional lender will use some more common sense. For example, if you're a self-employed person like a server, or you own a salon, or you're a tradesperson and you're a cash-intensive business, or if you write off a ton of expenses down and your net income is very low, they're going to say, Toma, in qualifying this client for us, please ask your client for 3 or 6 or 12 months of bank statements from their business, and let's look at the actual deposits in and deposits going out, and we'll make a reasonable sort of decision on what their stated income is as opposed to their verifiable and reported income needed with these traditional lenders. And so they'll take a lot more common sense approach to people that do not have traditional or reliable sources of income, like commission, for example. Then they'll take a higher percentage of the person's income than the traditional lenders may allow or be allowed to take. For example, a traditional lender at best rates will only allow 39% of your gross income to be attributable to your housing costs, your mortgage, your heat and your property taxes. Some of these alternative lenders will go up to 50% if they are comfortable with the borrower. And so easier on income, easier on credit, and more importantly, they're also a lot more sympathetic to the self-employed borrower and the newly self-employed borrower. For example, traditional lender will say, hey, if you've been self-employed for 2 years or less, we won't talk to you. Alternative lender will say, you're in for business for yourself and you've got a mortgage up for renewal 6 weeks or 6 months out. Congratulations, we will consider you. We will be sympathetic. So that's where the alternative mortgage lender fits into the Canadian landscape. By and large, more aggressive on pricing and fees up front, larger down payment or equity required, but a lot more latitude when it comes to credit, income, and business for self-tenure. So that does it for this week. Next week, I'll talk about the private mortgage lender as the last of 3 species in our mortgage ecosystem. But for now, have a great weekend. Happy hunting for a home, and I'll talk to you soon.